Hello and welcome to QML 28. My name is Jeremy London and we are excited to have you join us. And we have a great topic and a great guest today. And I'll just tell you, based on the feedback from Friday's session, it went really well. So we're excited for the topic and excited to talk about what we have in store today. We are using a new platform. We're using the Microsoft Teams live event platform, so it might look a little different than you're used to seeing. We're kind of figuring it out also. There is a Q&A tab, so feel free to send your questions in throughout the session, and we will have time at the end to answer some of those questions with our panelists. Having said that, we are going to turn things over to our Chief Financial Officer, Jim Guillaumin, with our session for today. Hi, Jim. How are you doing?
Doing A-OK. Thank you very, very much. Hold on here. Let me just get things moved around here a little. Okay. So first and foremost, I'm truly honored to have the opportunity to address such an incredible group of mission leaders and cover a topic as near and dear to my heart as finance. Certainly, I can't express the appreciation I have for each and every one of you for the hard work and dedication that you show day in and day out, supporting our clients, maintaining our systems, addressing the needs of our employees, making sure payroll's paid timely and accurately, selling new opportunities, and the countless other mission critical responsibilities that you guys manage on a daily basis. Again, I'm truly honored to have the opportunity. Before I really get too far into the presentation, I felt it was important to cover how and why financials and financial performance is so critical to the mission. Hey, there are certainly points in time when we might think that these two items, the Qualfon mission and financial performance, are in direct conflict. And frankly, sometimes that may be the case, but generally it's related to a specific decision or transaction. But the reality is, when you take a step back and look at the overall picture, one does not exist, at least for any sustainable period of time, without the other. Our mission is one of the key drivers of our financial performance. An example being the willingness of our mission leaders to go above and beyond for our clients and employees. And our mission is certainly not sustainable for the long term without strong financial performance. This is how we grow from making 15,000 persons' lives better to 40,000 persons and beyond. Results must be important. They're right there in our strides, our fundamental core values. Results: operate at high levels of performance, ensure that goals are met in an effective and efficient manner with an attitude of service. Our 4 agreements are also very aligned with financial performance. Keep commitments at Qualfon. Includes keeping our financial commitments, paying our vendors and employees timely, and all the other contractual commitments we have as a company. Add value at Qualfon. One measure of value is return, a truly financial measure. Move fast at Qualfon. Well, this one might be a little bit tougher, certainly when it comes to paying those vendors. We might want to not move quite as fast, but certainly the most relevant one is spend wisely at Qualfon. So wisely, not frivolously, but wisely also includes not being penny smart and pound foolish. For those familiar with the old adage, we have to be equipped to make the right financial decisions. Now that's a perfect lead into the presentation. So you may be wondering, what's this all about? Financials for the non-financial mission leader. What am I supposed to get out of this? Well, pretty basic. There are some concepts and some terminology that are talked about, included in various reports, hot topics or snapshot reports as an example. And we wanted to provide some clarity in that regard. What do I hope for? I hope that you can walk away with at least one, aha, I get it. That makes sense. Now I know why my manager keeps mentioning that, why I'm focused on that, I now know why and what to do. If only 10% or 5% of the mission leaders on this call walk away with that aha moment, we will have a positive impact on Qualfon's financial performance. So I wanted to take a minute to discuss the difference between accounting and finance. They're often used interchangeably. I'm often guilty of this, but there is certainly a distinction. Oftentimes, the larger the organization, the less gray the lines are between the two. But for an organization our size, they can be a little gray at times. So really, I feel the best way to describe the difference, and my team has heard me say this many, many times, is that generally, accounting is working on history, finance is working on the future, and when the future becomes history, the two work together. So more specifically, accounting is recording transactions and creating reports on items and time periods that have already occurred. This function is incredibly important as the accuracy, consistency, and compliance is overseen and reviewed by auditors, tax authorities, lenders, etc. Policies and standards rule in the accounting world. No accountant likes to do it, but policing these policies is part of their job. Some of you have probably experienced that policing firsthand. Finance, on the other hand, is working on the future, using the information provided by accounting and more critically inputs from key stakeholders to provide the financial analysis and planning. So for us, a lot of the product of that financial analysis and planning might be the flash reports, the annual budget, customer insight analysis, etc. To help the managers of specific operational business segments unearth opportunities to improve profitability. Where the future becomes history, for instance, during the month-end close, those two areas work very closely together. Finance provides inputs and helps analyze variances. They learn from the process to become more accurate in their forward-looking analysis. Accounting learns more about the business and what to be anticipating for recording and reporting purposes. I hope that provides a little bit of the distinction between the two areas and terms. The three key financial accounting statements that report the financial activities of a business are the balance sheet, the income statement, and the statement of cash flows. Considered by many, including me, to be one of the most critical components of any financial reporting package is the MD&A, or the Management Discussion and Analysis. These words behind the numbers provide the financial statement user with the key takeaways, drivers of the results, and variances versus expectations. The MD&A supports more accurate and informed decision making. Before we run through these three reports individually, it's important to note and fundamental that these three statements all interact to provide a financial picture of a company. One cannot see the correct financial picture without all three reports. As we go through them, I'll explain why and help connect the dots. The balance sheet. So one thing before we get into this too far, it's important to mention that the numbers in this presentation, so for instance in the balance sheet here, are purely hypothetical. It might say Qualfon Group at the top of the reports, but the numbers are not Qualfon's. Same for the income statement and the cash flow when we get to those slides. As really, this isn't an exercise to review Qualfon's financials per se, it's to share concepts. All that being said, while we may often think about or talk about the P&L, the profit and loss, or the income statement, really all three of those are the same. The financials really start with the balance sheet. Assets equals liabilities plus owner's equity, one of the most basic accounting concepts. The balance sheet is a picture of what we own, our assets, and what we owe, our liabilities, at a point in time. The net of these two is the equity. These assets we own and the liabilities we owe are separated between those that are short-term and those that are long-term. Short-term assets are those that are or can be converted to cash in the short term. Really, for short-term versus long-term liabilities and assets, it really has to do with being able to be converted, or debts that are owed within a 1-year period of time from the date of the balance sheet. So cash, accounts receivable, or the amounts we are owed by our clients, and inventory are examples of short-term assets. Short-term liabilities include amounts we owe vendors, employees, and others where we will need cash in the short term. The balance sheet is analyzed to make sure we have the cash, or things that will become cash in the short term, like those amounts that our clients owe us, our accounts receivable, to pay all our bills. Long-term assets include things like fixed assets or capital expenditures that have a longer life, or will help us generate revenue over a longer period of time, like our computers, our printers, all the cubes and furniture in our facilities. All those items are long-term assets that help us generate revenue over time. Long-term liabilities include debt, the money borrowed from banks to finance the business. So a couple of key terms that I wanted to make sure we had down here is accounts receivable, which is the amounts owed to us by our clients. Fixed assets, which are those investments in computers, facilities, etc. You might hear us call those capital expenditures or CapEx. And then accounts payable, which is the amounts we owe our vendors. And we'll mention those again later on. So what the balance sheet doesn't tell us is how much money we make, or how we make money. For this, we go to the income statement, or again, the profit and loss, or the P&L. This statement shows our income or revenue and all the categories or types of expenses required to make that revenue over a period of time. This income statement that is shown here on the screen is very summary level. There are all kinds of additional details behind this. Those additional details is the info that is used to push the buttons and pull the levers to additional profitability. So we actually, when we produce an income statement, we can produce that income statement by location or site, by client, all kinds of additional levels of detail that help those managers understand their business. But what I really want to focus on here are the big concepts. So as mentioned, at the top is our revenue. Right below that are the primary or direct costs to generate that revenue. For Qualfon, those direct costs are mostly labor. Our call center agents and supervisors, those assembling mailings and fulfilling orders in our marketing services business, and certain other positions. Those all fall into direct labor. But labor is by far our biggest cost, and the cost most people on this call can help control. But we'll get into that more later. We have other direct costs as well: telecommunication costs, paper, postage, printer, and material costs in the marketing services businesses, as an example. The difference between our revenue and our direct costs is our gross margin. This gross margin is one of the big areas that we focus on as far as how we're doing running the business, as this gross margin is the dollars we have to pay for all the other costs it takes to run the business. Our sales, general, and administrative expenses, commonly called our SG&A, or sometimes we refer to them as our fixed expenses. The SG&A expenses include the costs of all of our facilities, all the IT expense, sales, person office, mission, finance, legal, operation management, and executive teams, insurance, recruiting costs, mission costs, depreciation expense. All those are part of that SG&A. So you take the revenue and subtract the direct expenses, you get gross margin. Then you subtract the SG&A expenses and you get earnings before interest and taxes. Earnings before interest and taxes. You can see it there in the middle of the screen, or EBIT. So EBIT is the primary measure that we at Qualfon use for evaluating our profitability. And we often use them interchangeably. When we say profitability, we're really meaning EBIT. We really interchange those two terms. So also, sometimes we, and many other businesses, use a slight variation of EBIT, which is EBITDA, or earnings before interest, taxes, depreciation, and amortization. I've shown that math at the bottom of the income statement. So from there, basically, after EBIT, we then pay our interest costs that we might have, depending on whether or not we're borrowing, pay taxes, and we get to net income. All right, that was a mouthful. So let me go through a couple of the key terms again. So gross margin, which is revenue less direct costs, EBIT, which is earnings before interest and taxes, and EBITDA, which is earnings before interest, taxes, depreciation, and amortization. So one other term I wanted to add, and I don't have it on the slide here, is depreciation and amortization. So those are the value of those fixed assets that we talked about on the balance sheet that whittle down over time. So basically, we're buying those assets up front, then we whittle them down, and it becomes expense through our P&L over the useful life of those assets. So that's a key item to understand, that depreciation and amortization and how that ties back to those fixed asset purchases. So one key item as we move on is what the income statement does not tell us, and that's the amount of cash that we generated. For that, we need the statement of cash flows. If anyone is a believer that cash is king, it's our chairman. I'm not going to spend a lot of time here, but basically we start with the net income from our income statement, then add or subtract the change in net working capital, or the change in our current assets and liabilities. What do I mean? We can have an income statement that's showing all kinds of net income. But the reality is we pay our clients or pay our employees every week or every other week. And if the clients haven't paid us, we have to subtract the increases in our accounts receivable from our net income in calculating the cash we generate. We sometimes call that investing in working capital because it's an asset. We're investing in an asset, but that investment takes cash. So one of the other big components of that change in net working capital is the change in accounts payable, or the amounts that we owe our vendors. So if we are paying them over a longer period of time and growing that liability, accounts payable, then it actually improves our cash flow. So that change in net working capital is an important piece of the statement of cash flows. So then we have the other big components of a cash flow are the cash flows related to investing activities, which for us, it's mostly investing in CapEx or acquiring a new business, and financing activities like borrowing money or paying back money borrowed previously. You take all those puts and takes and you get the cash flow for the period. So one key term I wanted to go back and cover again is the change in net working capital, and that's the cash generated by or invested in our current assets and liabilities, which is really an adjustment to our net income to reflect those actual cash flows. So how does our chairman, our advisory board, the executive team evaluate our financial performance? Really, it's a combination of profitability, the key metric being EBIT, as we mentioned before, and the cash we generate. So to measure the cash, you can look at the change in the bank account. But another way is through a calculation known as free cash flow. This is the cash provided by operations less our CapEx or purchases of fixed assets. Okay, I know that sounds a little bit complicated, but if you go back to those comments on the cash flow, basically cash provided or generated from operations is our EBITDA, so not EBIT, because we're taking out depreciation and amortization, because that's non-cash. Where the cash is in the capital expenditure component. So we start with our EBITDA and we subtract the increases in the amounts our clients owe us, or plus if they owe less, and minus decreases in the amounts owed to other, or plus if we owe more. So basically that change in net working capital that we talked about. Less interest and taxes. So that's our cash from operations. Then you subtract the amount we spent on new computers, or cubicles, our CapEx, and you get free cash flow. So how can we improve our free cash flow? We can invoice our clients accurately and as quickly as possible, and not wait till AR is past due to start the collections process. So that results in less investment in working capital, or our AR building less. So, because that takes away our cash if our clients are not paying us timely. And we can manage the expectation of our vendors as far as payment terms, and try to manage the timing that we have to pay our vendors. The longer we can go paying our vendors, we get to keep that cash, so that improves our cash flow. And then certainly we can spend our capital expenditure dollars wisely. So making prudent, wise decisions when it comes to investing in fixed assets. But mostly where we can have an impact is through maximizing our profit opportunities. So this is a busy slide, but really it is built in a way to try to make this just as simple for us to get our heads around as possible. And really, this is really where the rubber hits the road. So a client provides us revenue opportunities, and that revenue opportunity, or hose in this diagram, can be pretty leaky. So penalties, recruiting shortfalls, attrition, absenteeism, not managing in and out of chair shrink, poor capacity planning, really in both the call center and marketing services sides of the business, can all reduce the revenue we realize from the revenue opportunity our clients gave us. The worst part about this is that revenue is gone forever. We can never get it back. We might be able to help make sure we don't lose it as much in the future, but the revenue that we already lost, it's gone. And in some cases, the client, may have given it to somebody else. That client depends on us to handle that work. So if we can't, because of any of these reasons, that disappoints the client, and they may go somewhere else for that work to be performed. So we've got to maximize those revenue opportunities. But even if we do that, there's still the challenge of keeping all the EBIT in the bucket, if you will. So the cost of attrition training, the cost of rework in the marketing services business, excess staffing and support ratios, overruns in site expenses, and corporate costs can all empty the bucket. We need to work together to maximize our profit opportunities. This is why we produce ratio reports and adherence reports, and sometimes have to VTO, and why we've implemented end-to-end for those that are familiar with that term, end-to-end, which is the process improvement initiative that's going on recruiting. And this is why our managers talk to us about keeping a close eye on all of these items. So some of you may have been wondering why up in the top of the slide here, there is a picture of an empty cubicle. And really, I put that there as a relatable visual guide for because a lot of the mission leaders on this call are supervisors or ops managers on the call center side. And this provides a relatable visual guide for what you as a supervisor can do to help maximize our opportunity. Is that cube empty because the person quit, because they attrited? Is it empty because that person was supposed to be back from break but isn't as of yet? Is the cube empty because of absenteeism? That cube costs something. the computer, the chair, the monitor, the cube itself. We lease the space it's sitting on, our rent, and there's no one there to service our clients, and certainly no one there to generate the revenue to pay for those costs. So really, from all the other slides, this slide is really, as I said, where the rubber hits the road, and really shows where, for you as mission leaders, and really as a manager, as defined under the 3 M's, this is how we manage the profitability of our business, is really the concepts that we talked about in this slide here. So we're almost out of time, and I know I threw a ton at you, and very quickly. And really, I hope all of you got something out of this today. And I can't tell you how much I've enjoyed spending the time with you and covering these topics. But we do have a minute or two should anybody have any questions. So Jeremy, have there been any questions we want to go through here?
Well, I'm opening that up now, and so while we're waiting for some questions to arrive, I'm going to put some of our other panelists on the spot here. And Al, I asked you this question on Friday. I'm going to ask it to you again. So you've had a warning this time. Okay, you've had advance notice. I asked Al on Friday to talk about this idea of balancing the business needs with our mission. We talk about our mission to be the best and to make each person's life better. So I just wanted Al to share some thoughts on how we balance that with the bottom line. Al, what do you think about that?
Well, thank you, Jeremy. I had forgotten the question, so you still got me by surprise. Same as no. What I remember us discussing was, very simple. If we look at our mission, it calls to help our employees find their vocation and actually develop their vocation. And we say in there that we want to do that with as many people as possible. And in order for us to be able to do that, as Jim was well saying at the very beginning, we need to grow. Our objective is still to achieve, I believe, is 40,000 employees, which is quite a bit more than what we have today. And in order to do that, we have to be the best financially as well. So what Jim is talking to us about here is really important because it shows exactly how to get there from all the standpoints that he's talking about: balance sheet, profit and loss, and cash flow.
Thank you, Al. We do have a comment here from Elizabeth. She says, great job, Jim. Very helpful walkthrough. And I love the hose bucket and leak image. Really makes it clear where we can lose opportunities for better profitability. And I love the visual, Jim, of the empty cubicle. And I love the way you explain that. I'm going to put Matt on the spot. Matt, as many of us know, was a site director for a long time. And I'm wondering, Matt, if you have any more thoughts about how someone at the supervisor level or trainer level or admin level can have an impact on the bottom line. Are you there?
Can you hear me now?
Yep.
Yeah, great question. The supervisors, I'm going to focus on them a little bit. They have absolute control over our profit opportunities. They're the front line with the customers. So much of the things that we talk about as far as in and out of chair shrink and attrition and how we control our labor costs up front, much of the opportunity that we can gain or lose falls right on them. They are our first step in achieving this profitability. So critical role to make sure that we're managing that correctly. Yeah, I can't say enough about it. So that if we're looking at that diagram, they own the revenue opportunity operationally right up front.
Great, thank you very much. Al, did you have a comment?
Well, yeah, we don't have any other question. I would love to hear Jim's opinion on this. Jim, if we look at the slide that we have in front of us right now, and if you were to put a Christmas list together, Jim, what would you say are the revenue leakage or the EBIT leakage items that we should pay most attention with, that have the most impact to our financials, would you say, Jim?
So, you know, I guess it's still pertinent during the COVID-19 crisis. Yeah, I want to be a little careful as far as, you know, what we're dealing with today versus what we might typically be dealing with were we not in the middle of this COVID-19 crisis. But certainly the attrition is incredibly, you know, impactful on the financials. So not only do we miss the revenue opportunity by those individuals not being in their seats, available to take calls, we also have the attrition training cost to fill those positions again. And in most cases, that expense, you know, is paid for by us, not by the client, and comes right out of our EBIT. So not only did we lose the revenue and, you know, no, we didn't have the cost to produce that revenue because the person had attrited, but we lost the margin on that revenue. So then against that margin, we then have all the cost of the attrition training and recruiting, hiring, then training those individuals. And then typically for, you know, the newer individuals coming out of training, you know, are not quite as productive as, you know, people that have been around longer. So there also is an impact on the performance or our KPIs for those clients. So there's no question in my mind, you know, attrition is the most costly of any of these items here because it's, you know, it's hits on both sides.
Great, thank you, Jim.
Thank you very much, Jim. And we have run out of time. We want to thank Jim for an excellent presentation. Thank you all for listening. If you had questions that we didn't get to, we are able to pull those questions later and make sure that those get answered for you. We will see you next month for QML 29. Thank you so much for joining, and we'll see you all next time. Bye-bye.
Thank you. Thank you, Jeremy.
Thank you.